You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. So be sure to check out our live stream via the Mixlr app, or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. Learn more about QuickStrike at bantix.com. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. Visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music can mean only one thing. It is time, once again, for TWIFO, This Week in Futures Options, a program where we break down everything cooking and popping off on the other side of the fence. Maybe you want to talk some energy. Maybe you want to talk some equities. We get to that on this show, too, of course. And, who knows, maybe rates or metals or who knows, ags, crypto. You never know. Fluid milk. You never know what's going to make it onto the program. That's why you got to tune in every week. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, at least we like to hope so, the Options Insider Radio Network. You guys know where to kick the tires and light the fires, as always. And, of course, however you listen, live after the fact, hit us up. We do indeed like to hear from you guys, your questions, your comments, your insights, your pearls of wisdom, your suggestions for topics, the products you want us to talk about. All that good stuff and more. We do love to hear from you guys. All right, and joining me on the program today, let's see who we got. We got, actually, our old friend, the rockiest of lobsters, or I guess as some folks call him now, the cold water lobster. I'm not sure. I'm not a lobster guy, so how all that delineation breaks down. But he is Andrew GIOVINAZZI from OptionPit.com by way of Carmen Line Capital. Mr. G, what is it these days? Is it rock lobster? Is it cold water? What is the cold water thing going? What is that?
What was that? Constantine? Was that his general question about this? He's not eating rock lobsters. I still think the rock lobster as a catchy name is more catchy than cold water lobster. That I feel like that's a bit too generic for the Option Insider Radio empire.
Yeah, it doesn't have the same cachet to it that a rock lobster does. No, you might want to eat a cold water lobster, but you want to listen to a rock lobster. I think that's how.
I think that's a fair way to put it.
Is how all that. So yeah, the last emperor casting a little shade there on your name there, sir. But that's all right. You'll recover. as you are wont to do. Let's keep on rolling. Let's kick things off, sir. By the way, our buddies, Mr. Sean in particular, he's off once again traveling hither and yon from Footsie Russell. He'll be back on the show down the road, probably next week. Mr. Nick and those guys over there as well. We had a good one last week from D.C. If I do sound a little bit different again this week, it's because I'm on the road yet again. No rest for the wicked here on the old program. But the TWIFO doesn't end. The live stream doesn't end. We're managing to get the live stream working from where I am here remotely all the way back through the studio and out to Maine and back again. All sorts of magic going on behind the scenes to make that live stream happen for you folks out there. So hopefully you're liking it. Hopefully you're listening and having a good time. Let's kick things off, Mr. Rock Lobster, as we like to do here on the program. Let's look at the movers and shakers. But I'll leave it up to you. Should we start dark side and the ones that lost the most this week, or should we start positive and look at the ones that gained the most this week?
Let's look for the gainers. Gain.
Oh, that's uncharacteristically optimistic of you. You being a somewhat of a Maine curmudgeon up there, I expected you to go dark side. All right, let's go upside. Let's go positive. Top 5. These are all the things moving and shaking over there on CME Group. By the way, you can find it for yourself, all these movers and shakers, and do all the analytics for yourself, cmegroup.com/TWIFO, TWIFO. That's the place to go to kick the tires and light the fires. Click on the Market Scans tab. You'll see exactly what we're talking about here. Number 5 on this week is good old Brent, up about 2.2%. Interesting week out there in the energy markets. We're going to get to all that in a little bit. Number 4, copper, up 2.5%. An interesting one. Hasn't been a huge option story, but as I chatted with Derek from CME last week on the show, that story is changing. That story is growing. And, copper is a predominantly Chinese demand-driven product, but it has been growing, and electronic execution is growing out there. And once that starts growing, then the volumes usually follow along with it. Number 3, palladium. Another one, not a huge option story, but an interesting name nonetheless, up 2.76%. Number 2, rough rice. Everyone's favorite up there, rough rice, 2.95%. And rounding out the top 5 here to the upside, we got good old RBOB gas up a little over 3, about 3.3%. To the downside, let's go here. Number 5 on the downside is the 30-year, off almost 1.5%. Number 4, corn, off a little over 2%, about 2.2%. Number 3, the Ultra Bond here, minus off about 2.25%. Number 2 here, numero dos. The old euro dollar off 2.75%. And number 1 with a bullet to the downside, nat gas, lighting up the tapes. Mr. Rock Lobster, you're our guest. I will allow you to pick where we start our soiree into the world of futures options today. Do you want to go your old stomping grounds of equities? Do you like maybe some energy or metals or something else? What's lighting up your tape? What do you want to talk about this week, sir?
Well, of course, I just like the thought of rough rice, although I know very little about it. A couple of things is energy. I know, like rough rice. Just because I like saying it sounds like ruh-roh, but why? So I'm actually going to go. I got to go macro because that's what I watch. That's what I look at, and treasuries that have been doing pretty well this year, all of a sudden with the trade kerfuffle, we had a lot of, we'll just call it volatility last week and beginning of this week. Why is why are bond prices down and yields up? How about let's start there. I am confused, to be honest.
Oh, well, there's a certain segment of the audience out there that will be excited because they want more rates. Everyone always wants more of their product on the show. They want more ags, they want more rates, they want more lean hogs, whatever it might be, Mr. Rock Lobster. Someone out there wants more of it on the old show. But we can go to rates. I mentioned the 30-year was off. It was on the bottom of the top 5 list. Maybe let's start there in 30-year land. Not an area we talk about a lot on the show, which is always fascinating to me. Come into Showtime, like I said, off. It's off about 1.5, almost closing in on 1.6% now here for the week out here in terms of the 30-year. Again, with all this trade war stuff, 30 years not always where you're looking for where the action is. We talked a lot about 2-year of late and other parts of the curve inverting and madness, dogs and cats living together out there. But look, we're looking at 30-year because that's what's lighting it up here this week. Vol, as you might expect, off slightly a little bit this week. So a sell-off. Unlike all of you who've been trained for years on the equities, a sell-off in the rates doesn't necessarily translate to volatility across the board. The lion's share of the paper out here this week, from an options perspective, a little over half, 54%, coming on the Dees side of the ledger, and it was the 168 even calls. For a frame of reference, listeners coming into the show here, we're at about 162 and almost an eighth. I like the old eighth ticks again. So very close to it. We're at about 162 is our at-the-money strike here. So 168 calls dominating the paper here this week. Number one with the bullet. There were about 23, almost 24,000 of those. The lion's share coming on Tuesday with about 17,000 of that 24,000 or so going up on Tuesday. So the big day there, a good chunk of that over half opening, and about 4,000 yesterday, about 1,800 today. So the big days Tuesday and Wednesday here for these 168s, and the lion's share over a good chunk of that opening. So obviously some back and forth action on that strike, but a good chunk of that opening. Followed number two here, we've got actually some downside. So at the money puts here. These are November, there we go, 162 puts. My screen's going crazy on my listeners. The 162 puts with about 45% of the paper going up. Is between Nov and Dees, they did almost 99%. Actually, they did 99% of the paper out here this week. And the 162 puts are where the action was out here in Nov, to the tune of nearly 18,000 of those going up. Pretty even throughout the week, about 5,800 on Tuesday, 4,300 on Wednesday, 48, almost 4,900 today. So pretty even slate, a good chunk of that opening here on the week. So an interesting week out here in all things 30 year. Mr. Rock Lobster, when you're looking at rates, where do you hang your hat? What kind of analysis are you looking at out there?
Mostly is if we can, because since we're the only major country with a handle in front of our interest rates, like my biggest thing is, where does all this go? It's how you have to pay Greece to lend it money now. So what do interest rates mean anymore? I think the central banks are, and I really would like them to stop this, and let's just take whatever pain there is now instead of 5 years from now. So as far as rates go, yeah, I'm glad we still have positive interest rates. We should have positive interest rates. Everybody should have positive interest rates. Because to me, that at least means there's some kind of room somewhere. So, I would like to see our rates start to climb again, because that would mean there was a little bit of pressure, off the inverted yield curve and all that kind of stuff. But I would like to see a little less demand for treasuries. So I think right now there is some funk, maybe liquidity squeeze. I don't know in the bond market. I know there's a lot of repo madness from last week to this week on settling things. There's a lack of dollars. So anytime that the Fed has to buy treasury bonds, it's still a little weird. This rate situation is weird with such a huge issuance of bonds. So I don't know how long it lasts. I would like it to start going in what I think would be the right supply and demand direction for once, but it hasn't yet. I just figure it will at some point.
Yeah, let's look here really quickly here how we look from a skew perspective. Not a heck of a lot of skew action out here in the 30 years, I think, as you might expect. Let's see this week. It shows that those calls were being probably biased to the upside to buying there on those 168 calls in Dees, because that Dees call skew getting a little bit richer this week, gone from 3.3% rich to the at the money now this week, nearly 4%. So someone liking themselves a little bit of upside out there. In Dees, the puts are pretty much unched at about 1% cheap to the at the money. Since we're talking, before we go on to our next product category, Mr. Rock Lobster, since you invoked macro, it's all your fault. You mentioned macro, not me. Interesting nuggets here to check out from our friend of the program here, Mr. Blue Putnam, the senior economist over there at CME. He posted something this week called 7 Themes to Ponder as we head for 2020. Again, Erik and Blue put out some interesting stuff all the time. Their research is always front and center. Head on over to cmegroup.com. It's easy to find. It's usually right on top of the homepage, whatever their most recent research is. And the number one thing Blue has of his top 7 to ponder is that a massive QE, so quantitative easing, listeners, has damaged liquidity and helped to slow economic growth. He says the government bond purchases by central banks have gotten so large as to dramatically reduce, since 2015, they've dramatically reduced liquidity in those markets, damaging risk management efficiency and leading to more sluggish growth, especially in Europe. So there we go, talking about the bonds there. Number 2, the trade war may take its toll on the yuan and the euro. He thinks the trade war may expand to Europe this fall. there have been some inklings of that. If that happens, of course, that's going to hit things like German automakers and the German economy and many other things in some nasty ways. He also points out number 3, the trade war leading to stagnating corporate profits, equity market volatility, and no U.S. recession. This is kind of an interesting one here because you would think, a trade war would lead to the opposite. It would lead to a lot of volatility, as we've seen, and a lot of other things that maybe would come as a bit of a surprise. But it's interesting what Mr. Rock Lobster Blue saying here, that the trade war and all these other things could be good news for labor markets and economies driven by U.S. consumer spending, since a recession is likely to be avoided as long as consumers keep spending. Profit growth stagnation likely to lead to increased equity market volatility. I thought he initially said there was going to lead to less market volatility, which didn't make sense to me. But he's saying it's going to lead to more volatility, which I think you and I can agree with, Mr. Rothlasser. We've certainly seen that playing out in the equity space right now, right? We have seen a lot of vol, and a lot of it can be traced back to the old Vol-Fefe index of what are they tweeting today, right, sir?
Exactly. I mean, what was it? Since the Chinese or the U.S. walked away from the trade negotiating table in June, I believe, when everything kind of was starting to get back to and then all of this other, local political stuff, at least for the U.S., with the impeachment, all through a bunch of uncertainty on the whole mix. A lot of that got created. All of a sudden, we had this like tweet cycle volatility and hasn't gone away. And at least in the short term, I don't see it going away at all. So until something fantastic or at least better than what we've had happens, I think we're stuck with it for a while.
Number 4 here on Blue's list is an interesting one. This is one, if you listen to this show, it shouldn't come as any surprise to you. Middle East oil shocks no longer pack the punch they once did. If you look at the call skew out there in WTI, and Brent and other things are great examples of that. That we saw 5% of global production taking off the board a couple of weeks ago, and the market barely budged, and the call skew barely budged. So if that can't budge the needle anymore, then the Middle East clearly not the big driver for energy prices anymore. It's clearly global demand is the large part of the story there. Number 5, he says, is gold. Is it responding to global tension or rate expectations? He says the debate on gold has now shifted. It's all about the Fed and about rate hikes around the world versus global fears. So interesting stuff there on gold. We'll get to that in a little bit. And of course, number 6 here on Blue's 7 things to watch here. Fed to return to data dependency. This is the old school economist coming out in Mr. Blue. Economists like to watch whether the Fed is looking to do things like justify their existence to the White House and to the government, or to actually go back to what the economic data is telling them to do. And sounds like he's leaning towards the latter. Also, number 7, he says overestimating U.S. inflation and underestimating productivity growth. Then talking about how we view inflation and how it impacts our views for things like productivity growth. Mr. Rock Lobster, is that macro enough for you? Did that satiate your macro appetite?
It definitely it helped it helped the macro hunger that I have, if that was the right phrase I could use. It definitely fed the beast on the macro side. I know you come to TWIFO, talk some vol futures, and all of a sudden we get into the world of, macaroni.
Yeah, so if you hate macro, blame the Rock Lobster. It's not my fault. He dragged us down those roads. Since we're talking macro and the impact on things like volatility, let's talk equities, because that's been an interesting one. That's obviously your bread and butter these days, Mr. Rock Lobster, at least from a volatility perspective. And we're seeing some interesting movements out on that side of the fence as well, at least coming into showtime here. The equity side of the space back in rally mode. Most of the major indices were up over 0.5%, at least as of the start of the show. I haven't had a chance to check in. Maybe the worm has turned markedly since then, but I don't think so. Our old friend VIX taking a nice lift this week. It's about 18 and change right now. That puts it up a little over a handle from where it was last show. It spiked to over a 20 over the week here. It hit a high of 20.3 on Wednesday before giving a lot of that back coming into showtime here. But still, it has been interesting to watch the vol space. Also, our old friend, the volatility, a.k.a. VVIX, taken up as well, up to that much-watched, much ballyhooed triple-digit level of 100. So that's up about 3.5 points from where it was last week. So if you like to watch those kinds of indicators, maybe time to start paying attention. And our old friend, Mr. Rock Lobster, very interestingly, our old friend RVX, a.k.a. the VIX of the Russell 2000, a.k.a. the small cap volatility, almost exactly unched from where we were this time last week, Mr. Like last week when I was in D.C., it was at about a 21.97. It's at about a 21.93 right now. Isn't that somewhat crazy to behold, sir, that we are unched from a small cap vol perspective week to week?
Yeah, I think it is. Also, it also has I think it's a symptom of just the Russell not being able to get out of its own way lately. Not doing a whole lot. It feels like it's kind of one of the it's the lagging big index, I would say right now. And I'm not sure because maybe they disproportionately own more oil or more small oil and gas exploration companies like that. It hasn't made the big strides that would it's not like it's doing for this year. I guess what is it, flat for the year, and the S&P 500 is doing a little better. So it hasn't really gotten off the mat. It hasn't gotten off the mat yet. I think that's why there's no vol in it. It's just sitting there, kind of it's kind of doing it's the Elmer Fudd right now of the big indexes, I'm afraid to say. I know Russell, sponsors this show, but it's just right now they're not making it happen.
I like that analogy, the Elmer Fudd here. We got some people looking at some downside here. We'll get to that in a little bit. But what's lighting up your tape out here from an equity vol perspective this week, sir?
Well, a couple of remember those massive SPX put buyer, and they already started selling some of those out. I did see there was some upside VIX early in the week, and then by later in the week, they started just taking profits. So I think people have or traders have just gotten smarter at trading the like what I would call vol used to trend a little deeper and a little longer, and now it's much shorter. And I think people are stepping up, and when VIX gets down around 15 or 16, while we're in this trade war thing, they start buying longer dated vol, and when we get to 20, they get rid of it because that's the range we're in. So I think until we get out of this trade war thing, I think that's the range we're going to be stuck in.
Does seem to be the case. Someone else is also stuck. We talked about Russell 2000 earlier, how it hasn't really gotten out of its gear. Someone, though, Mr. Rock Lobster, just loves some far out-of-the-money puts out here in Russell. It continues week after week. If there's any size in the Russell options, and these are the ones obviously going up over there on the CME Globex platform, it's longer term, and it's pretty far out of the money. The Russell coming into Showtime off almost exactly 1%, listeners. And looking at about a 1485 is our at-the-money strike. Seeing once again farther out, this time beyond D's, out to March. The March 13 half puts, the big trade out here this week. Doing a fair number here. All that going up today, actually, so I don't have open interest numbers on that. So a lot of far out of the money. It's kind of been a theme, Mr. Rock Lobster, ever since we started watching Russell options here, at least the ones going up on the CME platform. Obviously, you can trade RUT a lot of different ways. You can trade it on the options. Let's see where you can trade IWM. There's a lot of different ways to carve up that Russell pie if you are so inclined. But it is interesting to see, at least on the CME platform here, someone continuously keeps bidding up those pretty far out and pretty far longer term type of puts. Does that surprise you, sir?
Not really, because the reason why I think is people they want the protection, but they want to be long. And I think that's another reason why VIX hasn't gotten down to that. Like, if you remember the zone of the monk, it has not been able to maintain that this year at all. And I think the reason why is every rally is met with pretty steady out of the money put buy.
That seems to be the case. Let's keep rolling, sir. We got a lot of categories to squeeze onto the program. We were talking about our movers and shakers of the week, and the top, I guess you can say the bottom of our bottom five, really, if you're being honest, because it is the biggest loser of the week. But our biggest downside mover this week was in the energy space, but it was in nat gas, our old friend nat gas, off 4.5%. So what do you say we take a journey over to the nat gas side of the fence, Mr. Rock Lobster, next? Does that float your energy boat, sir?
It does float my energy boat. I think the worst thing that happened the best thing that happened was fracking, and the worst thing that happened was fracking. And unfortunately, when we were producing all this stuff, we never exported it. There were no real export abilities for natural gas to speak of because it was consumed all domestically, and nobody ever thought to build anything. and nothing got built during the Obama years. They're starting to kind of speed that up now, but and even in the Bush years, because we basically consumed all the natural gas that we produced in the country. Now we've got so much of it, they're practically giving away or burning it. So at the prices that it is, we need, I think there are a lot of markets that could use it because natural gas is much more expensive everywhere else. It's just getting it there. So I'd be happy to see what we can uncover in natural gas world today.
Well, nat gas has kind of been a theme of the day. We were even talking about it on the Odd Block, as you recall, Mr. Rock Lobster, on the Option Block program, the Odd Block segment of that program, where we were talking about I think you called it a grudge match. It was a cage match here on ECA, which is a natural gas explorer and producer. We talked about 27,000. This is a $4 stock. So very cheap stocks had a rough year over the past year, and that's been a theme in the nat gas producer and exploration side. They've had a rough year over the past year. And someone putting up 27,000 looks like a lot of back and forth trading, lifting the offer, hitting the bid for 50 cents. Pretty aggressive juice out there for an option that's expiring in a couple of months, and for a stock that's $4, paying over 10% yield. Not a bad deal there, Mr. Rock Lobster. So interesting stuff, and that one was one of our big profile trades. Just coming into today's show, actually doing that on the Odd Block. And then today, of course, I think this article actually came out maybe yesterday, but it's just in the last 24 hours. The nat gas has kind of been taking the world by storm. The Journal putting up an interesting article about nat gas producers, how they've just been taking it on the chin, like our other friend we just talked about there in the Odd Block. The futures had just recently had their longest losing streak since 1990, with the front month future contract falling in 12 consecutive sessions through October 2nd. So that goes into October 2nd. A bit of a lagging indicator there. And when it dropped net during that period, about 16%. If you look year over year, it's off about 30% from those levels a year ago. As Mr. Rock Lobster alluded to, fracking has kind of been both a boon and a bane, more bane than boon these days. And people are hoping, ironically, in most parts of the world, they don't hope for a cold winter. But, of course, when you're in the nat gas business, you hope for the coldest of cold winters. But people are even thinking that won't be enough to really boost demand enough to get this out of this glut and have names like we just talked about, ECA, also a lot of other names out there, EQT, but other names have just been taking it on the chin, and Antero Resource, you name it, Gulfport Energy, all these names have been taking it on the chin of late in the nat gas space. And that doesn't seem to be changing. Let's look at the options, because like we said, this was lighting it up here to the downside this week from a net futures movement perspective. Let's see here what's going on. We already talked, it's over 5% here net on the week. And let's see what that front D's future off about 4.3%. And the vol, a bit of a mixed bag. That front contract, which has about 20 days or so to go, a little bit less than that, is up slightly from a vol perspective. And you go out to D's, that vol's off about half a point. And then you go out beyond that, out to Jan, it's off a little bit as well. Then you go farther out in the curve, all the way out to March and beyond, and the vol's up a little bit again. So kind of an interesting, funky term structure out there from a vol perspective. If you want to know where the action was this week, it was out here in Nove, 61.5% of the paper getting pretty much as close to expiration as they can get, which in the case of nat gas right now is about a little over 2 weeks. And looks like 61.5%. The big trade. Okay, Mr. Rock Lobster, I'm going to play a little guessing game with you because it's fun. We said right now a nat gas is at about a little bit south of 2.25, about 220 is the at the money strike out there. I already said it was front month paper that was lighting it up. What contract do you think people were flocking to in the front month the most this week in nat gas?
Do you want the term or the strike?
It's already front months. I gave you the term. Just give me the strike.
Okay.
Give me the strike and call or put.
Okay, 225 calls.
That's not a bad guess, actually. I probably would have leaned maybe somewhere in that category as well, but no, it was the 2 even puts. Huge lines in the sand, or maybe hedging. I don't know what this is, but tons of paper. 36,000 of these bad boys going up this week, Mr. Rock Lobster. 13,000 on Monday, 12,000 on Tuesday, and 6,500 today, about 4,000 on Wednesday. Total, like I said, 36,000. The OI, ironically enough, looks like a lot of back and forth because there's only net about 5,000. So opening about 5,000 of that 36,000. So it seems like there may be one of your old school cage matches on that strike as well, Mr. Rock Lobster.
Yeah, no, that's the but the law of big numbers works for commodities too. I think $2 is a psychological spot because what's nat gas doing? 250, 250. Like it's so it's either some people's thinking free money or somebody else is saying, okay, we break $2, we're really going to go into the basement. So it is a good cage match style strike for people to get excited about.
Yeah, we got a lot of cage matches going on in nat gas right now. Cage match upside calls, and that's, or maybe at the money calls in that ETF we were just talking, or that stock we were just talking about, and now here cage match downside puts here in nat gas. The next up 17,500 of the 210 puts. Then we go up to 2.25 puts for 12,000. Mr. Rocklobster, you got to go all the way. The first calls are only 9,400, and that's the 260 calls. Then we go 240 for 6,000. Your beloved 2.25s, only 5,400 contracts. There's no love for 2.25 calls, Mr. Rocklobster. What are they doing out there?
I don't know. I guess near the money doesn't matter to them. They want the big bucks. They want to swing for the fences.
Well, despite the fact that all the action was in the puts, the skew action was in the calls. Remember, this is the contract with a little over 2 weeks to go, so the skew is going to be maybe a little bit more fluid than a contract we're looking at a few months to go here. The calls getting a lot more love this week. They were 1.2% risk at the money. This week, 3.5%. The puts are ironically about unched, which is they were pretty much about even without the money. They're still even pretty much a little bit slightly bid this week, but the calls are where the action was. So even though, from a skew perspective, even though the volume was all in the two puts, didn't budge the skew. It was all to the call. So interesting stuff, Mr. Rocklobster. You don't get a chance to talk nat gas enough here on the program, but it's definitely one that merits a little bit of inclusion here this week. All right, Mr. Rocklobster, you're our guest. I allow you to choose where we hang our hat next year. Where do you want to go? Pick your poison.
How about metals? Let's do metals.
I've never heard of metals. What are you talking about?
It is a ferrous substance or non-ferrous substance. They make stuff out of it: cars, jewelry, pickaxes.
Oh yes,
clam rakes,
pickaxes and clam rakes. There you go. That's right where the Rock Lobster's brain goes, listeners. Pickaxes and clam rakes. Let's go to metals. Ironically enough, another interesting report coming out of our friends over there on the CME economic team, this time from Mr. Erik Norland, who does a lot in the metals side. He's actually had a lot of interesting papers over the years about gold volatility as kind of like his bread and butter over there from a research perspective. This week he's talking about gold versus equities. He says, is gold about to outperform equities? You can find this one for yourself over there on the CME homepage. And he has an interesting approach to it. He says, what happens when you revalue equities in a non-fiat currency? Like gold. He says if you do that, if you ignore the dividends, the S&P 500 and gold have produced similar price returns over the past 90 years. 90, listeners. On average, equities have produced only about 0.96% better price per gain per year than gold since 1928. Of course, that's with taking dividends out. You put those dividends back in, it changes the equation a little bit. Then the outperformance of equities jumps up to nearly 5% per year on average, which almost 5% a year since 1928. That's a lot. The current S&P 500 dividend yield is actually quite low, though. It's only about 1.91%. That's about half its historic average for a lot of reasons, not the least of which the fact that stocks have been off to the races of late. So I encourage you to check this one out, listeners. It's an interesting. They have a lot of great charts about the various performances of gold and the equities in different environments here. Pretty fascinating stuff. Gold charts easy for me to say. Redenominated gold in terms of S&P on the gold valuation. Fascinating things. Again, I encourage you, if you're a metalhead, I encourage you to check this one out. Let's go on over there now. You can play the home game for yourself, cmegroup.com/TWIFO. If you're doing that, listeners, head on over to the metals category. And let's go. We were talking silver a lot recently, so let's switch it back up. Let's switch it back up to the big dog. Let's go to gold. Gold here coming into Showtime off, not quite 1%, about 0.85%, not surprising. Broad equity markets are in rally-ho mode, so that means gold probably taking a break, and that's pretty much what we're seeing. The at-the-money strike right around 1,500 so we're threatening that 1,500 strike to the downside. Haven't broken it yet. It's actually close to it. We're 1,500.0 right now, coming into the latter portion of the show, so threatening it to the downside, but not quite through it. Off about 10 handles. Or actually a little more than 10 handles, about 12 handles this week. So that puts, again, almost 1%. Gold vol has been a bit of a mixed bag, off a little bit this week. Mr. Rocklaus, we talked about this before. Gold vol is an interesting area of exploration because on the one hand, it's crazy cheap, and it has been crazy cheap for a long time. So you might say, oh, that's kind of dead money, right? There's no real reason to sell it, certainly. And if you buy it, well, maybe it's not that exciting. But on the flip side, gold moves, and it certainly moves enough, particularly if you're diligent with some of your scalps, to actually make some money with that a little bit of long gold premium. Where do you fall? I know it's not a thing you want to sell right now, but where do you fall in this kind of strange conundrum that is the long stagnation of gold volatility?
And bond volatility was something, and that the pit crazies actually we're talking about, and it actually has been a pretty decent. It has been a pretty decent trade for the last couple of months. It's moving around. It's been when it trends just enough to make like strangles pay and stuff like that. About the last week or so, it's kind of just gyrated while we've been waiting for trade news number 2 or 3 or whatever to come out. But for the most part, it was kind of a reliable premium buy, at least a scalping, kind of a gamma scalping premium buy. I would mention that underlying gold volatility, though, like I look at GLD, but I would assume the futures are the same. 90-day vol is pretty high in there, so the actual underlying vol is pretty high relative, at least the way I look at the ETF volatility. So, but the options are the stock GLD and the options have been kind of a little stuck now for about the last week and a half, while we wait out trade war number 2.
Everyone was playing that trade war wait, that Vol-Fefe game. Let's see what the gold game was playing this week here. You mentioned, like you said, Vol has come up a little bit, so any move to the upside in gold, it looks suddenly dramatically overpriced because it's actually up. But you're right, it has been interesting to watch. Obviously, everything from a Vol perspective is always relative at the end of the day. Coming into Showtime, let's see what was lighting it up out here this week. 43% of the paper was in that front Nove contract, but the biggest trade of the week was actually out in DEES. It was the DEES 1470 puts. Remember I said we're threatening 1500 to the downside, listeners. Downside puts where the action was this week. 5,510 of those going up. Actually, 5,865. But of that, 5,510 going up today. So a lot of interest in near downside puts here in gold coming into today's show. So obviously we don't have open interest numbers for those because most of that just went up today. But interesting stuff here. So near downside puts, I've often joked that the gold bugs get all the love and all the notoriety out here. But clearly when there's a little bit of concern about breaking through that even number to the downside, they're not afraid of picking up some puts. Let's look here. What else was number 2 here? Here's the gold bugs we know and love. The 15-half calls going up 4,440 times. These were in Nove, so near a term paper. Looks like a lot of this was actually closing to the upside. So maybe some gold bugs deciding discretion the better part of the valor. They're seeing a bit of a sell-off, trying to take what they can get to close out some of these calls here. The total of about 4,400 going up this week. A good chunk of those actually today. 1,300 going up again today. So we don't, again, have all that OI numbers out there. Almost 1,600 going up on Tuesday as well, slightly closing there as well. So near term, slightly out of the money calls, and then a little bit longer term, out of the money puts. Let's look quickly at the skew out here. This Nove contract has about 18 or so days to go, and that's where the lion's share of the paper was. So we'll look there. It's beyond our 2-week bellwether, listeners, so it's not too crazy from a skew perspective yet. And let's see here. The calls are where the action is. Last week they were 5.2% rich to at the money. This week they're 12.3% rich, so getting bid up quite a bit. Some of that's, of course, getting closer to expiration here, but also obviously, this 15-half calls. There was clearly, at least coming into this, a bit of a bias to the upside there in terms of buying them. So maybe the gold bugs, not quite done. Maybe they are opening, or maybe they are indeed swing. That paper was net bias closing, but maybe there was a little bit of back and forth there too. Maybe someone had overwritten and buying them all back to close it out. Either way, the calls getting juicy up there. The puts also having a little bit of a move here. They were pretty much exactly even with the at the money. So the puts were kind of flat last week. This week, they're getting cheaper, about 7.4% cheap to the at-the-money out here. Mr. Rock Lobster, does that surprise you at all? We're seeing calls get bid and puts get offered, at least in the front month contract there in gold. That line up, that jive what you're seeing out there in products like GLD, sir?
Yep, because everybody's looking for that next leg up in gold, right? Is it going to get to, back to 1,500 for GLD, what is it, $1.50? Are we going to get that move? And I think part of it is the Fed is sounding like a little less dovish and like a little more hawkish, like, hey, unemployment's, 50-year low here, so let's get past this trade thing and we're not going to worry about rates. So I think there is, and gold is what I would call like, everybody wants to take the risk off, so they buy gold. And they're looking, I think, for the next leg into the end of the year, to be honest. So that the call buying and the skewiness on the upside is not a huge surprise in there.
Mr. Rock Lobster, as our guest, I will leave it up to you. Do you want to try to hit one more product, or do you want to make sure we squeeze in the listeners on the show? What's your call?
Let's squeeze in the listeners.
All right, you're a charitable fellow. Let's do it then. Let's time listeners. Time to get you guys on the program with a little bit of your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's Mixlr.com.
All right, everybody. Time for your feedback. Let's see what you guys have on the brain. First off, Mr. Rock Lobster, we have a deceptively simple one here from Barrett Wade, who wants to know, hey there. Well, hello. Hello back to you, Barrett. He says, do you guys have a simple rule of thumb to keep from overpaying for an option? Well, simple. It's a deceptively simple question because there are many layers to this onion if you decide to peel it. The simplest route I like to go, Mr. Rock, maybe it isn't that simple. Maybe it seems simple to me, but maybe to a newcomer it wouldn't be. But something like a vol cone, where you can look at that and see historically where your trade lines up from an historical volatility perspective. Are you paying pretty much around the average level of volatility for this contract in this time frame? Are you paying maybe one standard deviation above, one standard deviation below? That'll give you some frame of reference for where you sit on the historical timeline. So you'll know if you're buying something that's 2 standard deviations below the average volatility, maybe you got a good deal there. Maybe there's a reason why that is. Same deal if you're selling that. You should probably look at that and say, maybe I want to second guess at least selling this until I know more about why vol is so deflated. So that's a good starting point. That's where I like to point people. Mr. Rock Lobster, you do webinars and mentoring sessions about this kind of thing all the time. What are your simple rules of thumb to keep from overpaying for an option, sir?
Well, the simple rules on that are, I think the easiest thing is, what's your 10-day vol? How are things moving? So if you buy options, unless you're making, let's say, if you're making a short-term trade, you want to kind of have the vol wind at your back. Is there enough of a move or momentum to make option buying easy? Like my rule is I feel like the option I buy, I want the movement to pay for the decay, if that makes sense. If you're buying a 6-month or 1-year option because you're looking for like a bigger, longer, deeper type trend for a trade, you still want to pay what I would call look at more of the absolute implied vol at that point. So like short term, it's more of a realized vol trade. Long term, you're buying the vol level. So that's stuff I look at every day. So that helps me keep from when you get the itchy finger where you want to buy something, you're like, I'm paying too much for that. Maybe I'll find then after that, I'll find a way to make it cheaper, either a spread or something like that to kind of defray the cost in the short term.
Yep, he lives in that world every day, listeners. So Barrett and the rest of you are intrigued by such things. Reach out to the Rock Lobster. We'll tell you how to do that in a little bit. Next up, we got Brendan Ward. He's responding to us talking about last week or so. The CME Group, of course, planning to launch Bitcoin options in Q1. He just chimed in, said, that'll be interesting. I'll definitely be playing these. Well, I think you and a bunch of others there, Brendan, a lot of people were excited by that. Now, I know we were. We've been bugging CME. I've lost track of how long we've been asking them. Doesn't matter who came on, which product category, whether they were crypto or something else, ags, that didn't matter. I was always bugging them. When are we going to see those Bitcoin options? So I'm glad to see that we finally at least have a time frame. We don't have a concrete date yet, but we have a time frame for when we can expect these. So that's certainly a lot more than we had even a couple of weeks ago when it was still up in the air. Let's see here. Tom Liam. He's got two first names here. Tom Liam wants to know, are commodity names where the call skew is very high good candidates for covered call writing? Interesting question. Yeah, that's something that pops up in the commodity space quite a bit, more so than you see in, let's say, a traditional equity space, listeners, of course, where, you know, most of your equity and single name stocks outside of your, let's say, your small biotechs and your crazy names going into earnings, most of them are going to have the traditional investment skew where the calls are going to be offered from a vol perspective and the puts are going to be bid. And you're not going to see a lot of opportunities where covered calls are super sexy in that environment because you're not going to get the juice for it. It's just not the way those products shape up. But in the commodity space, could be in the metals, could be in the ags, could be in energy, could be a lot of different areas. You see that. That's why we talk about the skew so much on this show, because the skew changes and it moves and it flips and it inverts and it changes from week to week. And so that's exactly one of the setups you kind of want. You want a name that's going to be paying you a lot from the upside call perspective. Now, of course, you have to do your homework as to why that call skew is bid. If people are expecting a very sharp, enormous move in the next few sessions, then maybe you don't want to write that covered call. At the very least, you want to give yourself a little bit of that leeway to capture some of that upside. But if you like those levels and you're comfortable with what you see, then by all means, like Mr. Rocklobster, look at that name we just talked about, that that stock that was paying over 10% till November on those effectively slightly out of the money covered calls. So there are names that do that. That was a stock, but you can see similar things in the nat gas options when those get bid. So Mr. Rocklobster, if you're looking at a commodity side and the futures option side, and you see a name that's paying pretty juicy levels from a vol perspective on the call skew, is that something that gets your ears perked up, does it get your spidey sense tingling, sir?
It does. I mean, the upside is I don't really think of commodities, I guess, as a buy right thing, but I guess there's commodity funds that do that stuff all the time because it's the expensive junk to sell. So I see why people could do it. And in equities, when you usually see you have higher skew, the market really thinks that stock's going to blow up or something. So I tend to look at it a slightly different way. But, I mean, commodities, ultimately, it's, if there's a squeeze, and it makes sense because that skew is always there. I could see doing a buy ride in commodities that way, like against a future. I can see it.
High praise, sir. He can see it. I can see it. If someone could do it, and I wouldn't immediately pshaw them and say wag my finger at them and say no. So well done, sir. Yes. So yes, that is a good setup. Obviously, that's what you're looking for in a covered call environment. You want juicy calls. That's a nice thing. Just as always, whenever there's a strange, aberrant setup in the volatility, make sure you have some inkling as to why. That's always a good way to go. If you're doing it in a small biotech name and you know that they're about to have an EPA or an FDA approval coming out or something along those lines, maybe you want to keep your powder dry. Same thing if you're doing it in ag options and there's an FDA report coming out. Maybe you just know what is driving that aberrant change in the call scheme. If you're comfortable at those levels, you think that's a good risk reward, then by all means, that's a setup that is highly, highly attractive. Listen, that's what makes the commodity option so attractive versus your traditional equities. They can get that those little bursts of juice out there, for lack of a better term. And that makes it all so fun. And speaking of fun, unfortunately, listeners, that's pretty much where the fun on TWIFO, at least for this episode, comes to an end. But before we go, I want to thank my cohort here, Mr. Rocklobster, for joining me, doing the rare bit of double duty. Maybe we'll see if we can make it triple duty tomorrow. Mr. Rocklobster, if folks are intrigued, they like the commodity side of the fence, and maybe they want someone to walk them through things like we talked about, the gold volatility, maybe some other types of skew and how that impacts their trading. Where should they go? What should they do, sir?
Yep, goodoptionpit.com. We have all kinds of mentoring programs for volatility, positioning. You could take it into commodity options. And I mean, we actually have a lot of, we do have a lot of pitties that do trade. They trade like oil and gold because they like the margin in the CME and in the other exchanges, the other commodity exchanges. So, optionpit.com, and go to I think it's mentoring or memberships is where you want to go.
One of those two. You still call the
one of those two, something like.
You still call the poor people pitties. So they have my pity for being called pitties, sir. But check it out. Optionpit.com is the place to go. Of course, if you want to learn more about the equity premium harvesting side and all the data and buy rights and strategies they have over there, as well as maybe some stuff about trend following, active versus passive, small cap versus large cap vol, all that good stuff. FTSE Russell, FTSE Russell. .com is the place to go to kick the tires and light the fires. Give them a follow over there on Twitter while you're at it. Of course, you know where to find all the some fun stuff from CME, CMEgroup.com. Erik, great reports over there. Blues, great reports over there. A lot of good stuff over there. The FedWatch tool, I know a lot of you guys love that as well. And, of course, you can kick the tires over there, CMEgroup.com/TWIFO as well. And on behalf of myself and the Rock Lobster and Sean and all of our friends over there at CME and everyone else, I want to thank all of you for downloading, streaming, subscribing, for listening live, for sending in such great questions. Keep them coming. And we'll see you back here tomorrow for Volatility Views. Then we do it all again starting on Monday with Option Block. Then we come all the way back to Thursday for another episode of This Week in Futures Options.
This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixler.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.